Alright, hello everybody, and welcome to another episode on my channel. So today we have an exciting episode for you. We're going to be looking at one of my key stock portfolio holdings, specifically Vici Properties. So we'll be looking at my investment tracking spreadsheet, seeing how much of a percentage that Vici Properties makes of my total YouTube dividend growth portfolio. We'll be looking at how much annual dividend income Vici Properties provides to me. We'll be looking at the broad business overview of the company, looking at their most recent investor presentation. We'll be taking a deep dive into their financial metrics with a focus on dividends and dividend growth. Then we'll be doing a valuation on the stock of Vici Properties. We'll be trying to determine whether we think the stock price is currently undervalued, at fair value, or overvalued. Then we'll be looking at the pros and cons of possibly buying into Vici Properties or Vici stock. And finally, I will conclude with my final thoughts on what I'm going to do with my Vici position. Will I be selling my position? Will I be staying on the sidelines? Or will I be buying more? So if you're interested in any of that content or topics, I encourage you to listen, follow along, and hit that thumbs up button. Now, without further ado, let's go and dive right into the video. So we're going to make this a little bit bigger. All right, so Vici Properties makes up about 3.7% of my total YouTube dividend growth portfolio. Now, when we look at the annual dividend income, we can see that it is the second largest provider of annual dividend income to my portfolio at 8.6%. So a strong dividend payer here in my portfolio. If you scroll down and look at the annual dividend income, we can find Vici Properties here. Provides me with roughly $71.86 of annual dividend income in US dollars. Let's go and look at the business. All right, so Vici Properties, again, this is just the business overview, is one of the country's largest owners of gaming, hospitality, and entertainment destinations. So Vici Properties was recently included in the S&P 500, again, being included in the top 500 companies by market capitalization in the Standard & Poor's Index. It's an experiential real estate investment trust, so a REIT, that owns the largest portfolio of market-leading gaming, hospitality, and entertainment destinations, including Caesars Palace, Las Vegas, MGM Grand, and the Venetian Resort, Las Vegas. Now, Vici Properties has a diverse portfolio, again, focused in this gaming and hospitality sector. So we scroll down, we can see their strategic focus, and they have a strong focus in this specific sector, or what they call a highly focused approach, focusing specifically on these experiential and gaming assets, which they consider to be high quality. So they have 54 leading gaming facilities, which equates to 124 million square feet owned, roughly 450 restaurants, bars, clubs, and sportsbooks, and roughly 60,000 hotel rooms. Let's go and look at their investor presentation. So what I've done is I've gone ahead and picked out what I thought were the most relevant slides from this presentation, and I'll be sharing this briefly with you. So Vici Properties trades under the ticker VICI on the NYSE, or the New York Stock Exchange, and it is a triple net lease REIT. So again, if you're not familiar with this term, the triple net lease REIT, I'll leave a link in the description and in the top right hand corner to a video I previously did on realty income. And I encourage you to watch that video to determine what a triple net lease REIT is. But essentially, a triple net lease REIT provides the leaser the lessee or the renter, they have to pay specific costs. So they do not just pay the rent. They have to pay the rent, utilities, maintenance, taxes, etc. All the costs associated with running the building actually gets charged back to that specific renter, and Vici Properties does not have to pay that. They just collect the rent. So that is essentially what a triple net lease REIT is. And again, I encourage you to watch the video I previously made on realty income to look at a definition of that. So they own highest quality property portfolios of market-leading gaming, hospitality, and entertainment destinations. So significant scale and stable cash flows. So Vici is the second largest triple net lease REIT with 2.9 billion annualized cash rent and 100% rent collection from the formation of the company to the present date. So they've collected on 100% of their rent since they have been in business or formation up to the present date. That is great. Contractual escalation with inflation protection. Now this is key. So 50% of the rent roll is CPI linked, and it has a CPI linked escalation, and that is in 2023 right now. So essentially what that means is every time that inflation, and again, we're living in high inflation times, when CPI, or the consumer price index, again, a measure of inflation, rises, then Vici actually has baked into their contracts with these casinos that they rent the buildings out to on the Las Vegas Strip, that they can raise their rent in line with inflation. So again, super great, and it provides that nice inflation protection because the rents will also increase at the same rate or at a similar rate that inflation increases, providing Vici with that increase in rental revenue. So 2023, about 50% of the rent roll with those CPI linked escalations, and 96% of the rent roll with CPI linked escalation over the long term. So again, over the long term, almost all of their rent roll is going to be linked to CPI escalation protections or inflation protection. So very, very great point here for Vici Properties. Demonstrated track record of growth. So they've announced 35 billion of domestic and international investments, raised 21 billion of equity proceeds since they were formed in 2017. So again, most recently formed in 2017. So this is a fairly new company, and we can talk about that a little bit later. Mission critical complex real estate. So the gaming regulatory environment, it creates high barriers to entry and limits tenants' ability to move locations, contributing to 100% occupancy rate. Again, a great point. I actually didn't think about this point, but the gaming industry is very highly regulated in terms of compliance, and that can create very high barriers to entry to other competition, and therefore limits the tenants' abilities to move locations or go to different operators, and this contributes to their having their 100% occupancy rate. Tenant transparency. So 80% of the rent roll is derived from SEC reporting operators, providing transparency into tenant performance and health. So again, this speaking to their largest two tenants, which we will look at, being Caesars and MGM Grand. But because they are also public companies, those need to provide audited statements or audited financials to the SEC or the Securities Exchange in terms of compliance. So again, providing those financial results with complete transparency. Investment grade balance sheet, so a strong balance sheet. It was added to the S&P 500, like I said before, in June 2022. Non-commodity experiential real estate, so they are focusing on this triple net lease model with these experiential assets. All right, so this is a chart showing their tenants. So here we can see the percentage of annual cash rent and the actual tenant here, along with the properties and the dollar value of that annualized rent over here. You can also see the weighted average of the lease terms here, so WALT. And again, if you look at this, we'll look at this column by column. But basically tenants, you have Caesars, MGM, The Phoenician, Hard Rock, Penn, Jack, Century, Cherokee Nation, Eastern Brand, Foundation, Pure Casino. So 11 of these tenants make up 100% of the annualized cash rent. And the largest here being, like I said, Caesars and MGM make up about 76%, so almost 80% from these two renters here. So again, very, very concentrated in terms of their rent, but they are expanding into other parts of experiential gaming and hospitality. So, but again, these companies, they've all paid 100% of their rent since the formation of the company in 2017, and that is a function of them basically owning great properties on the Las Vegas Strip. Now, as you can see here, the annualized cash rent, which was at 2.9 billion. They have the number of properties here, a total being 54, and the weighted average lease time or lease tenants. Again, you see very, very long lease time. So these lease contracts on an average of around 41 years. So very, very long contractual leases that provides us as investors with great basis for predicting the ability of these companies to pay that rent or the insurity of them to pay the rent, because they are locked in for roughly an average of 41 years. So long lease terms, great predictability in terms of rental revenue, rental increases, and again, just speaks to the power of owning these specific trophy properties. All right, so I really like this slide. So this basically compares Vici to other triple net lease REITs. So again, Vici to other triple net lease REITs. So occupant business model. So Vici focuses on the experiential, terms of their business model. The other ones, or the other REITs, are generally, conventional goods and services. The underlying asset financial transparency. So again, super high because the gaming regulators require gross gaming revenue reporting from the assets. Again, highly regulated, usually audited by third-party auditors. So again, super transparent here. Comparing again to other REITs, and they consider the other REITs to be low. Barriers to entry, high like we stated, because Vici owns these highly regulated properties in specific experiential locations such as Las Vegas, which makes it very high, or a high barrier to entry for competition. You cannot just go out and say, I want to go and buy a block on the Las Vegas Strip. I want to go and build a building there. Super hard, next to near impossible, unless you have this right relationships in Las Vegas or in these specific places, which Vici has, and a lot of other people don't. So again, high to low. The average rent per asset, super high because they're renting out to these multi-billion-dollar businesses, compared to the little bit lower here in terms of the other REITs. Now, type of real estate, again, differentiated. It's not a commodity. It's very hard to get this, as opposed to being highly commoditized in the normal triple net lease state. Remaining lease term, like we saw, basically 42 years. They rounded up from 41. And the other lease terms for most REITs, again, 8 to 11 years. So basically 1/4 of that. Again, showing the power of Vici to lock in their tenants for long time periods. Rent collection, even in 2020, so they're specifically stating, even during the pandemic, they collected 100% of the rent from their tenants, as opposed to other REITs who actually may have collected anywhere from only 70% to 99%. Again, just showing the power of Vici to collect rent from these casinos and other tenants. Cash flow volatility, very low, none to date, they say. So again, because they've collected 100% of the rent. Long-term CPI protected rent roll. So 96%, as we saw, of those long-term leases, they have CPI protection or inflation protection built in, and they will get that escalation when it takes place. As opposed to other triple net leases, again, 16 to 85%, a broad range here, but most of these REITs have like a 1% rental increase each year. So again, nothing compared to this CPI protected rent roll that Vici enjoys. Same store rent growth, roughly 2% compared to the industry standard here at 0.4%. All right, so the estimated CPI protection, again, I'm just going over this because I think it's such a great part of their business. They can increase this rental revenue basically, and this rent roll, just based off the consumer price index or inflation. So super great to see here. And again, it just speaks volumes to the value of the real estate that they own. All right, so now we're going to look at Vici properties here on Seeking Alpha and look at some financial metrics. So let's look at the stock price. So over the past month, Vici properties is down about almost 8%. Over the past 6 months, it's down about 11.5%. And when we look at it year to date, it's down about almost 9%. So again, REITs and interest rates, it's a very important relationship. Even properties or real estate, you should know this. As interest rates rise, the valuation of REITs or real estate usually tends to fall down because the margins of that property get squeezed. So as interest rates go up, you have to pay a higher interest rate expense, therefore squeezing the margin between your rental revenue and your interest rate or your net income profit margin. So that is what you should know, and that is why a lot of REIT prices usually react negatively when interest rates rise. So as we can see here, the 52-week range, Vici Properties trading between about a $27 price to about a $35 price on the low and high end. And as we can see here, the dividend rate. So the dividend rate pays about a $1.66 dividend. That results to a 5.74% dividend yield. So very, very strong dividend yield here. Now let's go and look at those dividends. All right, so dividend safety given a score of B minus, dividend growth A minus, dividend yield a B, dividend consistency a B. Again, very, very strong grades here. Let's go look at the dividend summary. So again, like we saw, 5.74% as a dividend yield on a forward basis, very, very strong. Pays out $1.66 on a forward basis, results in a nice low payout ratio of 65.64%. If we look at the dividend growth rates, 5-year dividend growth rate at 17.42%. So very, very strong, and it's at dividend growth for roughly 4 years. Let's go and look at that dividend growth. All right, now remember, Vici Properties has only been in formation since 2017, and it was a result of a spinoff of the other hotels and their business. So again, fairly new. So this is all fairly new. So please take all these numbers with a grain of salt. But as we can see here, the dividend growth rate for the past 3 years has been about 9%. And when we look at the dividend growth rate over the past 5 years, a nice 17.42%. So great dividend growth here and great compound annual growth rates. Now, if we go and look at the dividend safety, because us as investors, we love getting dividends, but we want to make sure that they're sustainable, that the company can safely pay out that dividend without causing any financial strain on its operations. So what I like to look at is the cash payout ratio. So again, at 73%, this is actually pretty good for a REIT. I believe that it's very, very sustainable in terms of a cash dividend payout ratio. And we also want to look at the all important adjusted funds from operation payout ratio, because REITs, they are valued and they operate on a funds from operation basis, and we want to look at them from that basis. So a nice 75.55%. And again, this is very, very sustainable in my opinion for a REIT. I've seen REITs where they usually pay out 90% of their funds from operations. And again, this, in my opinion, allows a lot of room for dividend growth for the future with this lower payout ratio. Now, Vici Properties did just have a dividend increase. We'll look at Business Wire. So we can see Vici Properties, and again, this was September 7th, so about a month and a half ago, so not that long ago. Vici Properties did increase its regular quarterly dividend. And again, this was the 6th consecutive annual dividend increase since formation. I love to see those words, consecutive annual dividend increases. So as we can see, Vici Properties increased their dividend by 6.4%. So great dividend growth. Again, anything above 4 or 5% in terms of dividend growth, I like to hear. It's like music to my ears. You're keeping up or higher than inflation in terms of dividend payments, allowing us as investors to lock in a lower yield on our initial cost of paying for that dividend or for that share. All right, so speaking to that dividend, again, this just shows Vici Properties dividend targets and lets us know that as management, they're thinking about us investors in terms of dividends when they give us communication around their dividend strategy. So Vici Properties dividend durability and growth, 100% cash dividend raised every year while targeting a 75% AFFO payout ratio. So like we saw, they were basically at 75.55% of adjusted funds from operations in terms of the payout ratio. So basically right in line with their targets. And as we can see, since 2018, each quarter, they have increased that dividend by roughly a 7.6% compound annual growth rate. So very, very high and consistent and reliable dividend growth in my opinion. All right, so what we're going to do now is look at a valuation. So what I've done here is I've taken a valuation spreadsheet from my friend at Dividendology. Again, thank you, sir. I appreciate it. If you haven't checked out his channel, I encourage you to check out his channel. He does great videos on stock valuations, including REITs, other stocks, banks. Again, feel free to check out his channel. I'll leave a description to his channel. A description to his channel in the link below. So we're gonna look at Vici Properties in terms of valuing these stock. So what I've done here is I've taken similar REITs in my portfolio, so Realty Income and Agri Realty. I've taken their stock prices, including their AFFO multiple, and it's given us an average of their AFFO being around 13.295. Now, if we look at Vici in particular, they trade at a price to AFFO of 13.56, so slightly above the average. Now, what this gives us is an intrinsic value of Vici at roughly $28.37. Now, the current price here is $28.94. So this could suggest that Vici could be a little overvalued. Now, when we look at it from a dividend discount model, what this model does is it takes the dividend payouts and it determines a growth rate and then discounts that growth rate and gives you a DDM price per share or dividend discount model price per share for your company. So Vici Properties here, as you can see, they've had decent dividend growth and average growth rate here of 7.72%, like we previously saw in the past investor presentation slide. So a nice average growth rate. Now, I'm a little more conservative in terms of forecasting, so I used a 4% dividend growth rate here instead of the average 7%. And again, that's just because I am being conservative. I do not know what the future holds, so I want to give a little bit of a discount here in terms of the growth rate. Now, I'm using a discount rate of 8% or a weighted average cost of capital of 8%. This gives me a DDM price per share or dividend discount model price per share of $40.56, with the current price at $28.94, meaning that this could be 40% or up to 40% undervalued. Now, when we go to the output tab, we're not using the net asset valuation here. Again, a little bit less relevant in my opinion. We're using the AFFO multiples, which gave us a $28.37 value of Vici. The dividend discount, which gave us a $40.56 value of Vici. Both of these averaged together give us a $34.47 value of Vici stock. So the current price is $28.94. So us as investors, we always want a margin of safety when we're investing. This allows us to be able to scale into companies at what we believe are fair or undervalued prices. And then if the stock price does dip down, we have a little bit less of a chance or a little bit higher of a margin of safety in terms of our stock, basically our stock average price being in at a specific price. So again, it's very, very hard, but that's why you factor in a margin of safety. As the name suggests, you want to try to build in a little bit of a cushion in terms of when you scale into a company. So if we used a 10% margin of safety, we could see that this would be a buy at about $31, and it's currently trading at $28.94. If we used a higher margin of safety at 15%, this would still be a buy at about $29.30. So currently we would be buying this. If we were super conservative and we wanted to do a 20% margin of safety, we would be buying at around $27.57. So in my opinion, I believe that Vici is a strong company. So a 15% margin of safety would probably do. But if you are conservative, you could use your any other margin of safety. You maybe want 20% or 25%. That would totally be up to you. So we've gone through the valuation. We've looked at the investor presentation. Now I want to talk about some of the pros and cons of Vici Properties. So Vici Properties, again, great dividend growth. It's had a sustainable dividend payout. It has trophy real estate and long-term rental agreements. So those are amazing pros in my opinion. Now cons, it's highly concentrated in one sector, being gaming and real estate. It's dependent on the successful business of those tenants. So if people for any reason to stop going to Las Vegas or stop going to bars or clubs or restaurants or any of these places, then Vici's tenants would suffer poor financial performance and then in turn may not be able to pay their rent, which would cause Vici to also suffer that poor financial performance. Now again, those were the pros and cons, so take with that what you will. If we go back to the valuation, I want to see what Wall Street or other analysts have been saying. So analysts in the last 90 days, 14 of them have been rated a strong buy of Vici, 5 have rated a buy, 3 have rated it a hold. Now, when we look at the average annual or the average target price for these analyst predictions, and again, please take all this with a grain of salt, they have predicted a low of $31, a high of $43, and an average price of $36.84. Now, this could represent $27% of upside. So again, it could suggest that Vici is still undervalued. So I'm going to conclude here and let you know what I'm doing with my Vici position. So basically, in terms of my Vici position here, like I said, it makes up about 3.7% of my total YouTube dividend growth portfolio. I still believe that Vici is undervalued. I think it could be trading kind of around fair value, but again, I still, according to my calculations, believe that it is undervalued. So I'm going to keep buying shares. As these interest rates stay high, that is like a huge pressure on the real estate valuations and REITs particularly. So I want to be opportunistic and add to my REITs as the prices are at a fair valuation or an undervalued valuation. So Vici, I believe, is one of those REITs that I can continue to add in my portfolio, dollar cost average into, and build up my position here while the time is still opportunistic. Now again, the positives, it has great dividend growth like we saw, average dividend CAGR of roughly 7.5% over the past 4 or 5 years. And again, I believe that it will continue to have great dividend growth over the foreseeable future. So that's what I'm going to be doing. And if you have any opinions on Vici stock or anything else in the video I shared, I encourage you to leave those opinions in the comment section, and I will get to those when I can. If you enjoyed the video and you liked Vici stock or anything like that, then please feel free to leave a comment in the comment section. So I hope you enjoyed the video, and with that, I will see you in the next one. Thank you. Bye. Please note, I am not a financial advisor by any means. All of this was merely done for your entertainment purposes only. Please do your own due diligence when investing. Investing is inherently risky and you may lose money. Please note, I am not responsible for any investing decisions you make or any investing losses you incur. Thank you, and I hope you have a great day. Bye.